and saying it expects to spend even more in 2026. The conference call is underway. For more, let's bring in CNBC's Julia Boorstin. Julia, any guidance on 2026 capex?
Well, capex is really a big focus of the call right now. CFO Susan Li talking about it quite a bit. Both she and CEO Mark Zuckerberg talking about why they are raising their capex, saying it's all about investing to drive AI strength and how they need to maintain that position of strength. So they raised the range for 2025 capital expenditures to a range of $70 to $72 billion. That's up from a prior range of $66 to $72 billion. And the company did not share specific guidance for next year's capex, but CFO Susan Li just said moments ago on the call about the importance of expanding infrastructure capacity to enable Meta to seize opportunities, saying they expect capex dollar growth to be notably larger next year, saying, quote, "We are focused on preserving maximum long-term flexibility to ensure we can meet our future capacity needs while also being able to respond to how the market develops in the years ahead." Now, Lee also saying they expect to invest aggressively to meet those needs, both by building their own infrastructure and by contracting with third-party cloud providers. Now, that could indicate more cloud deals ahead, and Meta has done some big recent cloud deals, a $10 billion deal with Google in August, $14 billion deal with CoreWeave in September, and a $20 billion deal with Oracle in September as well. So, Melissa, now a new category of stocks that might be impacted by all these AI investments.
Yeah, Julia, keep us posted on the call, which is about 38 minutes in. Julia Boorstin. Once upon a time, higher capex was rewarded definitively by the stock market. Have we hit a point, Michael, in your view, where we are reassessing? We need to see ROI, and it is the turn here in terms of capex numbers.
Yeah, Melissa, I think that's absolutely the case. I think we're going to see more and more of this over the coming quarters. You know, many of these tech stocks, the tech sector in general, was so attractive for so long because it was viewed as capex light, and now it's capex heavy. You know, it's very similar to like an energy and exploration company within the energy space that constantly has to drill new wells in order to realize growth. These guys are all saying we have to invest ever larger amounts of capex in order to keep up with AI growth. And I think the value proposition, once you get to these levels, starts to diminish and the return on investment becomes much, much harder.
Yeah, Karen.
Yeah, so this is sort of what I was afraid of, that earlier on, capex was seen as good. What does the word notably mean here? I don't know. I'm scared
Sounds
of it.
Sounds like a lot.
I feel like notably is more than 10%. Mm-hmm. That wouldn't be notable to you, would it? I don't know. It seems like more than 10, which is, I think the street was looking for maybe, I don't know, a little over 10%. I think it'll be more than that. I mean, the underlying business is really doing well. They are getting returns. We see growth there, but I don't know that we're getting the returns on this kind of spend yet. So it's concerning somewhat. I think we'll hear what they... I feel like they should just rip the Band-Aid off. What do you think the number's going to be?
Right.
Okay, they should tell us what they think the number's going to be for capex.
I mean, the backdrop, though, is Meta has always been given sort of the luxury, the benefit of the doubt, because every dollar of capex would benefit their own bottom line. But we were talking earlier about, Llama 4. Not so great. I mean, so what are the results of all this spending?
Yeah, I mean, Meta AI is like a distant behind all those other chatbots that we're seeing right now, and they're trying to fix it. They went out to spend hundreds of millions of dollars. They want to do this research lab. They're kind of saying, don't look here right now, look there. We want to do super intelligence. And, when you talk about what they're getting out of this, obviously, like ad targeting has been really good. I think a lot of the metrics are demonstrating that. At a certain point, you're kind of going to hit a wall, and then they're going to have a lot of competition. If you think about how is OpenAI going to monetize ChatGPT, they're going to get in the digital ad game. Like, that's going to be a big way of how they do it. So you're going to see pressure around the whole space. But the one thing I'd mention about this build out of these data centers, they're just now starting to hit the debt markets, right? And you think about this deal that Meta just did to build this data center in Louisiana. Well, they're basically taking a 20% stake. There's going to, Blue Owl is lending them $27 billion. It's going to go into a special purpose vehicle. And, it's all this stuff, man. And some of that debt is literally going to be issued at 1% above. Like, it's going to be, Mike can get in here, it's going to be like junk. and then it's going to find its way into all these ETFs and all these big, debt portfolios. So all of this stuff is becoming very financialized, and we've been talking about this for a couple of years. These companies have been funding this build out through their cash flow and through their large cash balances, and now it's hitting a wall because 30% of their revenue, it's got to stop at some point, right? So this is, to me, the spot, and Oracle is in the worst spot of all of them. I think their debt to equity is at like 500% or something like that. They're going to be the ones holding the bag, then the neo clouds, and then these guys, because they've done this off balance sheet stuff, it's probably going to end up pretty good for them.
Yeah, this is where you get the parallels to the late 90s and early 2000s. You had a tremendous amount of debt issuance going to build out basically the fiber optic network that became Fios and everything else. Now, in fairness, you had companies doing this that really had no business levering up their balance sheet and ultimately went bankrupt. And I don't think we're worried about that with respect to the Mag 7 and some of these larger tech companies. But the story still rhymes. And you are starting to see a lot of this debt issuance. You're also starting to see guarantees now from some of these players to smaller infrastructure companies, construction companies, et cetera. And that's a new thing that we're seeing in the debt markets. Guarantees by Google for someone to build out a data center and issuing debt in order to do that. That's something that's never been done. That always makes me a little bit nervous.
So they took a $16 billion charge. So if they had not taken that, EPS would have been probably 10% better than expected. It would have been $7.25. The street was at about $6.65. They beat revenues by about, I think, 4% better than the street was looking for. Margins are now north of 40%. I get it that people are concerned about the spend. Where are they going from 69 to 71 billion? I mean, to me, that's a bit of a rounding error. But I understand this level that we're looking at now is where we traded down to at the end of July and held. So I actually think you buy Facebook here.